Okay, so I saw this YouTube video talking about dividends, and let's just roll the clip.
What if I told you that dividends do more harm than good?
So today I wanted to debunk some common misconceptions about dividends because this video is made by In the Money, which is a fantastic YouTube channel that I do subscribe to, which is fantastic for if you're looking for information on selling and buying options. Great place to look. For dividends, maybe not so much, because I see some very common misconceptions about dividend investing and people just kind of discounting it as being something that most people should avoid at all costs. And I think that's not telling the full story. So today we're going to debunk some of the most common detractors and arguments against dividend investing. I'm going to give my own thoughts on why I think they're wrong and why I think dividend investing is great for pretty much everyone. So the three concepts I wanted to talk about in this video is number one, the stock price goes down on the dividend announcement date and the ex-dividend date, the exact same amount as the dividend, so the price is going down exactly how much you're getting paid, so that's not worth it. Number two, you're paying more in taxes than normal investing. And number three, it's only for retirees that need the income. So number one, and the most common complaint that I see by the In the Money video that I showed at the very beginning of this video, is that on the dividend schedule, on the day that it goes ex-dividend, which means that everyone that owns shares the day before that is gonna get paid out that dividend, the stock price usually goes down by that same amount. We've actually found from studies that the stock price does not fall the exact amount, but that doesn't really matter because if we're investing for the long term, which is the whole point about this channel, I don't care what the stock price does in any given day. We're buying stocks that are going to go up over the long term, and I really don't care what the stock does on any given day. So if you're looking for short-term investing, this is not going to be the thing for you because dividends are not made for that. They're made for long-term investors that are using the appreciation of the underlying asset, the stock price going up in value, in addition to the dividend payout as another way to kind of supercharge your investing career as the reason why we're investing, not because I think the stock price is going to go up and the dividend payout is going to be entirely profit. That's not how this works, and that's okay. And even if the stock price does go down, I'm actually okay with that. When you look on YouTube, there are not many people that are pretty okay with their stock price going down, but I feel like I'm in the minority because I am okay with that because one, I dollar cost average regularly. Every 2 weeks I put money into the account and I buy my favorite stocks, and especially if it's recently gotten to its ex-dividend date, meaning the stock price has gone down by the dividend amount, that is a discount that I'm able to buy. And even though I'm not going to be able to take advantage of that on the next dividend payout date because it's already gone past that ex-dividend date, I'm buying these stocks for the long term. So if I can buy a stock at a 4% discount, I am 100% okay with that because that means that in the future, my valuation is going to be going down and I'm able to buy these stocks at a discount, which is totally fine for me if your time horizon for investing is longer than just a couple weeks. So dividend investing is not something that someone should be looking at for a short-term get-rich-quick scheme because that's not how this works. I want to put this graphic up on the screen right now because I think it's really important to show the power of reinvesting the dividend. So the dividends can be used for a lot of things, but my favorite thing is reinvesting them back into the stock that pays it for you. So on the left, you have the graph is kind of off because the scale really gets skewed by the 1982 to 2022 valuation. But just know that the blue is the dividends not reinvested and red is the dividends being reinvested. In that long-term valuation, you can see the huge difference that it makes having your dividends being reinvested versus not. And so you're still able to build wealth. It's just going to be over the long term, and it's not going to be I'm taking the whole dividend as profit, I'm using it to buy back into the stock and increase my position size, usually at a lower average cost, which I absolutely love. So that's the number one thing I wanted to debunk, is that the main complaint is that the stock price goes down by the dividend amount. So there's no point in buying into the dividend because it's just getting canceled out. We're buying stocks that are going to increase in value over time. I'm not worried about the daily movement. I'm worried about the long-term movement. If we're buying winners, I have no problem with the stock price going down on its ex-dividend date. Number two, you're paying more in taxes than you need to. This can be partially true, but can also be not true at all. It really depends on the situation. So dividends are taxed. Let's just get that out of the way. But it's different than long-term investing where you're just buying and holding and you don't pay taxes until you sell, because when you do get paid those dividends, you do have to pay taxes on them in the tax year that you're given them. Unless they're in a tax-protected account, whether that be a Roth account where you're not going to be paying any taxes on it in the slightest, or if it's in a different retirement account, you're not going to be paying the taxes until you remove the money from that account, so you get to push off that tax burden for a long time. But they've actually set it up in a way where they are viewed in a much more beneficial light than normal income. So you have different types of dividends. Not all dividends are treated the same, so I kind of wanted to explain the difference between them because you're going to be paying taxes on them differently, and when you start doing your taxes, if you haven't done them yet, you should really get on that. which is myself. I still need to finish them. So that's kind of motivation for me to do that this weekend. So you have qualified dividends, which are going to be most of the dividends that you should be getting. And they're going to be taxed at the capital gains rate, which is fantastic for someone like myself and most people, because if you're making less than, what is it, $44,625, you're paying 0% on those dividends. So for me, those are 100% free, and the highest tax rate is 20%, which is much lower than the ordinary dividend, which is going to be, we'll kind of explain where the difference comes in, but that can be taxed at the normal tax rate, which has the much different breakdowns of the tax rate, and it can go up to 37%. So when you have qualified dividends, which are going to be mainly from the US based companies, and there's a certain holding requirement that you need to have, they are taxed at a much more beneficial rate than the normal income. So yes, they can be taxed, but they are taxed much more favorably. And for someone like myself, I'm not paying taxes on them right now. Not my decision, because I just don't make that much money. That's 100% okay. So ordinary dividends are taxed like income. And ordinary dividends come from a variety of places. I'm going to put up on the screen right now all the dividends that have been paid out since, what is this, February in my retirement account. And you can see a pretty good spread of companies. You have AbbVie, which is Realty Income, Apple, Ford, QYLD, Microsoft, NextEra, and you see kind of a breakdown of most of them are being qualified dividends, meaning that I'm not going to be paying any taxes on them. They are in my retirement account, but let's just pretend this was a normal account. But you have a couple in here are the ordinary dividends, which is from Realty Income, which is a US-based company, but it has its own special thing. It's an REIT, meaning that they have to pay out a certain amount of their income. I think it's like 95% of their income to their shareholders, which means that gets taxed like ordinary income. And then you have stuff like ordinary dividend from QYLD, which is the NASDAQ covered call ETF. So in general, the ETFs are going to be paid out as ordinary income, going to be taxed that way. So that's why in general, I own mainly dividend stocks and not the ETFs. One, because I like having my dividends spread out over a longer amount of time, and two, I don't want to pay as much tax on them. So yes, tax burden is something that you really need to consider, but for someone like myself that's going to be making like $200 worth of dividends this year, I'm not super worried about paying taxes on that, especially because the qualified dividend tax rate that I'm at is 0%. So taxes are something you need to consider, but it's not as big of a deal as some people make it seem. So let's finish up this video with number 3, which is going to be retirees are the only ones that really need the dividends. So retirees use the dividends as a source of income. This is times where they're not working any longer and they're using that income to pay their bills. And the whole point is that they're trying not to touch their nest egg and just live off of the passive income from the dividends, which is fantastic. But you can have multiple things be true. You can have it be great for dividend investing for young people, as well as being great for retirees, because we're not using it the same way. Dividends are this broad, overarching topic that can be used in many different ways to kind of suit your needs. You can use the dividends for whatever you want, but the most beneficial way for a young person is going to be reinvesting them, whereas for a retiree, they're going to want them to pay off their bills because they don't need to accumulate wealth as much as they needed to 40 years prior. And that's why the dividends offer so much flexibility, because you can do whatever you want with them. So dividend stocks, on average, are not going to be as volatile as some of the growth stocks that people are promoting on their channel. But when you're able to use the dividend payments to reinvest back into that same stock, it allows you to build wealth. And if you need it to pay off bills or use it for ordinary income, that's totally fine. It gives you so much more flexibility, which is why I absolutely love dividends. And it means that they're not only for retirees. They are very beneficial for retirees, but they're beneficial for everyone. It gives flexibility that normal growth stocks don't give you. You can buy into a stock once and not touch it for 40 years, which is fantastic. But some people like the ability of being able to buy additional shares, which is that benefit, dollar cost averaging with those dividend payouts. And I think that's really beneficial. So you're going to see a lot of people kind of trashing dividends because they're not as flashy. It's not a stock that's going to go up 100% in a couple days, but it's going to be a stable way to build wealth over the long term. And it's something that I'm currently using to build wealth in my house fund right now. And I do have dividend stocks in my retirement account, which is that breakdown of the dividends that you saw earlier in this video. So I'm curious what the common misconceptions you hear about dividends and the reason why people say that dividends aren't worth using for normal people, and let me know in the comment section down below. Let me know what you thought about my breakdown, and let me know what stocks or concepts you'd like me to talk about in a future video. My name is Andy. If you made it this far, I really appreciate it if you hit that like and subscribe button. My voice is pretty shot because I am sick right now, and I'll see you in the next video.